Governor will now commence with his speech regarding the MPC announcement.
By the winners of the MPC Schools Challenge for 2016. They are the girls from Springs Girls High School with their educator, Miss Rachel Masaza, and the deputy principal, Miss Heather Jones. Congratulations and welcome. And let's get to the business of today. The UK vote to leave the European Union has dominated the global landscape in the past month. The outlook for the global economy has become more uncertain as the potential consequences of these developments are being assessed. The lack of clarity regarding the process going forward has had significant implications for global growth and interest rates as the prospects for further near-term monetary policy tightening by the US Fed recede. While there has been spillovers to the South African financial markets, particularly the exchange rate, the direct short-term impact on the South African growth and trade is likely to be fairly limited. Domestic growth has surprised further on the downside, and the outlook remains constrained. At the same time, domestic inflation outcomes have surprised marginally on the downside, but an extended breach of the target is still expected. The year-on-year inflation rate, as measured by the Consumer Price Index, CPI, for all urban areas, moderated to 6.1% in May before rising to 6.3% in June. Food price inflation measured 11% in June, below the recent peak of 11.3% in April, and was marginally negative on a month-on-month basis. Goods price inflation measured 6.7%, up from 6.6% in May, while services increased by 5.8%, up from 5.7% in May. The bank's measure of core inflation, which excludes food, fuel, and electricity, measured 5.6%, up from 5.5% previously. Producer price inflation for final manufactured goods continued its downward trend, declining from 7% in April to 6.5% in May, mainly due to a further moderation in price inflation of food, beverages, and tobacco products. This was below the consensus forecast of 6.9%. The impact of the drought is still evident in the increase in prices of agricultural products, particularly cereals and other crops, as well as live animals and animal products. The latest inflation forecast of the bank shows a marginal improvement compared with the previous forecast. Nevertheless, inflation is still expected to accelerate further this year and is only expected to return within the target range of 3 to 6% during the third quarter of 2017. Inflation is now expected to average 6.6% in 2016 and 6% in 2017, compared with 6.7% and 6.2% previously. In 2018, inflation is expected to average 5.5%, marginally up from the previous forecast. The expected peak at 7.1% in the fourth quarter of 2016 is down from 7.3%. The downward revisions are due in part to lower administered price inflation, despite a small upward adjustment in the international oil price assumption. The forecast for core inflation is lower than the previous forecast in the near term, mainly due to the lower starting point, but higher in the outer period. Core inflation is expected to moderate from an average of 5.8% in 2016 to 5.3% by 2018. Whereas previously, core inflation was expected to breach the upper end of the target range in the third quarter of 2016 for 4 consecutive quarters, a one-quarter breach at 6.1% is now expected in the fourth quarter of this year. Inflation expectations, as reflected in the survey conducted by the Bureau for Economic Research, remained relatively anchored at the upper end of the inflation target range. The second quarter average expectations for 2016 were 6.3%, up from 6.2%. Average expectations for 2017 were unchanged at 6.2% and were marginally down to 5.9% for 2018. Expectations of business people were more or less unchanged compared to the previous quarter. Both analysts and trade union officials revised up their near-term forecasts, while forecasts for 2018 were revised lower. Average five-year inflation expectations declined from 6.1% to 5.9% in the second quarter, with downward revisions by all groups. The median expectations of market analysts, as reflected in the Reuters Econometer survey conducted in July, show a moderate decline since May. Inflation expectations declined from 6.7% and 6.4% in 2016 and 2017 to 6.6% and 6.1%. The yield differential between inflation-linked bonds and conventional bonds, that is, break-even inflation expectations, declined across all maturities but remained elevated. The global economic outlook has been influenced by the outcome of the UK referendum. The financial markets displayed a high degree of volatility in the immediate aftermath of the outcome, but have stabilized to some extent since then. Nevertheless, the longer-term real impacts are expected to be negative for global growth, particularly for the UK and Europe, as investment decisions are put on hold during the transition period. The high degree of uncertainty is expected to persist for some time, as the magnitude of this slowdown is still unclear and is dependent on the nature and speed of UK's disengagement. Since the referendum, global growth forecasts have generally been revised down. The outlook for emerging markets has remained relatively subdued, with further downside risks in Turkey following the recent coup attempt and terrorist attacks. Recent outcomes in China indicate some improvement in the growth prospects in response to government stimulus packages, and this has underpinned a stabilization and moderate upward trend in commodity prices. The IMF growth forecasts released earlier this week have revised sub-Saharan African growth downwards. The region has been negatively impacted by lower commodity prices and severe drought in some parts. Inflation in the advanced economies remain low and still generally below target. The Brexit vote has also modified expectations regarding monetary policy in these economies. Although the Bank of England kept policy rates on hold at its most recent meeting, expectations are for a reduction in the policy rate in the near future, with the prospect of a resumption of quantitative easing. Markets are now expecting the US policy rate to remain unchanged for some time. At the same time, the highly accommodative monetary policy stances of the ECB and the Bank of Japan are expected to persist, with the possibility of additional stimulus. These developments have reinforced the global search for yield, as yield curves flattened across major advanced economy markets. The number of government bonds trading with negative yields increased further. This has provided additional impetus to renewed capital flows to emerging markets observed since earlier this year. While these flows are expected to persist, They remain sensitive to changes in expectations regarding US monetary policy and general global risk perceptions. The recent volatility experienced by the rand exchange rate has been driven mainly by external factors and changes in global risk perceptions. Although the rand depreciated sharply in the immediate aftermath of the referendum, it has reversed these losses and more so against the British pound. Since the previous meeting of the MPC, the rand has traded in a range of 15 rands 80 and 14 rands 22 cents against the US dollar, and has appreciated by 11% against the US dollar, by 12.9% against the euro, and by 23% against sterling. On a trade-weighted basis, the rand has appreciated by 12.2%. The rand has been supported by the global search for yield. There was a sharp increase in non-resident inflows to the domestic bond and equity markets in June and July. Since the beginning of June, net purchases by non-residents of 107.3 billion rands have been recorded. The rand also responded positively to the improvement in commodity prices and the unexpectedly large trade surplus recorded in May, which followed a small surplus in April. Despite this recent strength, the rand remains vulnerable to possible risk of global scenarios, changes in US monetary policy expectations, and domestic concerns, including the possibility of ratings downgrades later in the year. The domestic economic growth outlook remains extremely challenging following the contraction in GDP in the first quarter of this year. Although this is anticipated to have been the low point of the cycle, the recovery is expected to be weak. The bank's latest forecast is for 0% growth in 2016 compared with 0.6% previously. Growth rates of 1.1% and 1.5% are forecast for the next 2 years, down from 1.3% and 1.7% previously. The bank's estimate of potential output has been revised down marginally from 1.4% in 2016, rising to 1.7% in 2018. The growth outlook is corroborated by the persistent negative trend in the bank's leading indicator of economic activity. Business confidence remains low, with the RMB BER business confidence indicator falling to its lowest level since 2009 in the second quarter of this year. Recent economic data suggests that positive growth was recorded in the second quarter, with the mining and manufacturing sectors expected to add positively to growth. The more positive trend in manufacturing is consistent with the Barclays PMI, which has been above the neutral 50 level since March. The BER Manufacturing Confidence Index also improved, but still remains at low levels. The real value of building plans passed is indicative of some improvement in the sector, particularly with respect to residential construction. However, it is not reflected in the FNB BER Building Confidence Index, which declined further in the second quarter. Underlying the negative performance of the economy during the first quarter was the sharp contraction in growth in gross fixed capital formation for the second consecutive quarter by both the private sector and general government. These trends have contributed to the persistence of high rates of unemployment in the economy. Although formal non-agricultural employment increased in the first quarter of 2016, this was largely due to temporary employment opportunities created by the Independent Electoral Commission. By contrast, private sector employment contracted during the first quarter. Growth in consumption expenditure by households also contracted in the first quarter, with a sharp slowdown in expenditure on durable goods in particular. The FNB BER Consumer Confidence Index declined in the second quarter to low levels following a moderate improvement in the previous quarter. The BER Retail Confidence Index also declined sharply in the second quarter. Whilst new vehicle sales remained weak, vehicle exports recorded strong growth in the second quarter. Despite the surprise increase in retail and wholesale trade sales in May, consumption expenditure by households is expected to remain subdued given the low consumer confidence, high debt levels, rising costs of debt servicing, and slow employment growth. Consumption expenditure has been further constrained by the absence of significant wealth effects owing to the weak performance of asset markets, particularly the housing market. Credit extension to households also remains weak with negative real rates of growth. Average wage growth has remained relatively stable, but there are risks of increases in excess of inflation and productivity gains. There are as yet no clear signs of a recovery in the agricultural sector, and food price inflation is expected to remain elevated for some time. The bank expects food price inflation to peak at 12.6% during the final quarter of this year. There are some encouraging signs of moderation in some food categories at both the producer and consumer price levels, and future prices of grains have declined markedly. Should food prices stabilize or decline in the coming months, there is the potential for significant downside base effects next year. Exchange rate developments will also be critical in this respect, as will global food prices, which have reversed their recent negative trend. Despite supply disruptions and curtailments by a number of producers, the price of Brent crude oil has mostly traded within a band of $45 and $50 since the previous meeting of the MPC. The bank's model assumes a very moderate upward trend in oil prices over the forecast period, but there may be a degree of downside risk in the short term, with some upside risk in the outer period as global demand recovers. The domestic petrol price increased by a cumulative 60 cents per litre in the past 2 months due to both the exchange rate and international oil prices. However, the recent appreciation of the rand, coupled with a lower average oil price, has resulted in a substantial over-recovery in the petrol price, and a sizable reduction in retail prices is expected in August. The Monetary Policy Committee remains concerned about the weak economic growth outlook and the medium-term inflation trajectory, which remains outside the target range of 3 to 6% until the second half of next year. Nevertheless, there have been some improvements in the near-term inflation prospects following successive downside surprises. This is also the case for core inflation, where the expected breach of the upper end of the target range is now less protracted. Once the risks to the inflation forecast are assessed to remain on the upside, these risks have moderated somewhat. Global uncertainties appear to have delayed monetary policy tightening in advanced economies. The impact of the more appreciated rand exchange rate on the inflation outlook will depend to a large extent on whether the exchange rate is sustained at these stronger levels. Current exchange rate levels are stronger than those implicit in the forecast, providing some buffer to the projections. The rand remains sensitive to both domestic and external developments, and the recent trends can be quickly reversed. The outlook is clouded by uncertainty surrounding the longer-term market and global growth implications of Brexit. The implications for the rand and domestic growth and ultimately inflation could vary quite significantly depending on which scenario plays out. A weaker global growth scenario could also imply that there may be a degree of downside risk to the international oil price assumption, which was adjusted upwards. A combination of a stronger exchange rate and subdued international oil prices would have a favorable impact on domestic petrol prices in the coming months. However, the committee assesses the longer-term risk to this assumption to be on the upside as global growth and oil demand are expected to recover. Food prices remain an upside risk in the near term. There could, however, be a sharp decline in agricultural prices next year should favorable weather patterns transpire as forecast. The absence of demand pressures and weak consumption expenditure growth may also contribute to downside risks. Whilst the committee remains concerned about the overall inflation trajectory, the assessment of the balance of risks to the inflation outlook and the weak domestic economy has provided some room to delay further tightening of monetary policy stance for now. Accordingly, the MPC has unanimously decided to keep the repurchase rate at 7% per annum. The MPC is aware that some of the favorable factors that contributed to this decision could reverse quickly and remains ready to react appropriately to any significant change in the inflation outlook.